With $20 million in assets when he took over the Fidelity Magellan Mutual Fund in May 1977, his first position as a portfolio manager, a young portfolio manager by the name of Peter Lynch, quickly rose to become one of the most well-known investors in the world in the early 1980s. He then went on to make it the biggest mutual fund in the world between 1977 and 1990, exceeding the market by an astounding 29% per year annualized. Lynch achieved this by applying extremely fundamental ideas that he was eager to impart to just about everyone, because larger corporations either couldn't or wouldn't invest in smaller cap companies that haven't drawn much attention from analysts or mutual funds. Peter Lynch was adamant that small investors had an inherent edge over big companies. This video will show you how to put Lynch's tried and true method into practice, whether you're a registered agent trying to identify sound long-term options for your clients or an individual investor hoping to increase your profits. The 3 essential investing tenets of Peter Lynch. Lynch produced many books describing his investment philosophies after his exceptional track record managing the Magellan Fund attracted the public attention that typically follows great success. Although they are fascinating, his primary argument may be condensed into 3 points. Number 1, only buy what you understand. Our eyes, ears, and common sense are our best stock research tools, according to Lynch. Lynch took great pride in the fact that many of his brilliant stock ideas came to him when he was browsing the supermarket or having a casual conversation with friends and family. When we watch TV, read the newspaper, or listen to the radio, we may all perform first-hand analysis. We might also be on the lookout for fresh investing ideas when we're commuting or on a vacation. After all, 2/3 of the American economy is comprised of consumer spending. To put it another way, the majority of the stock market's activity revolves around catering to you, the individual customer. Accordingly, everything that appeals to you as a consumer should equally stimulate your interest as a potential investor. Number 2, always do your homework. Anecdotal evidence and first-hand observations are excellent places to start, but start research is always required to support brilliant ideas. When it comes to conducting thorough research, don't be fooled by Peter Lynch's homey simplicity, because it was a crucial component of his success. Lynch outlines 7 fundamental standards that he anticipated to be met for any stock worth purchasing when building on the initial spark of an excellent idea. Percentage of sales. A wonderful product that only accounts for 5% of sales won't have much of an impact on a business's bottom line. If there is a product or service that initially draws you to the firm, be sure that it constitutes a high enough percentage of sales to be noteworthy. PEG ratio. To determine how much expectation is built into the stock, one could look at the valuation to earnings growth ratio. One could look at the valuation to earnings growth rate ratio. A strong grower with a PEG ratio of 2 or higher have that earnings growth fully built into the stock price, leaving little room for error. You want to look for firms with strong profit growth and affordable prices. Favor companies with strong cash positions and below average debt to equity ratios. The corporation has choices in all kinds of market scenarios, thanks to strong cash flows and cautious asset management. Number 3, invest for the long run. Lynch claims that over a period of 10 to 20 years, equities are generally predictable, bearing many stocks. You could as well toss a coin to determine whether they will be higher or lower in 2 or 3 years. Although hearing such statements from a Wall Street legend may seem unexpected, it only helps to demonstrate how firmly he held to his beliefs. He continued to be familiar with the businesses he owned, and as long as the narrative remained unchanged, he refrained from selling. Lynch didn't try to forecast the market or the trajectory of the economy as a whole. In reality, Lynch once carried out research to ascertain whether market timing was a successful tactic. The study's findings indicates that an investor would have made a compounded return of 10.6% over a 30-year period if they had invested $1,000 annually on the year's highest day between 1965 and 1995. On the shortest day of the year, another investor who makes $1,000 annual investments for the same 30-year period will get a compound return of 11.7%. Consequently, despite having the worst possible market timing for 30 years, the first investor only fell behind in terms of returns by 1.1% annually. Lynch concludes that it simply isn't worthwhile to attempt to forecast the short-term changes in the market. If a corporation is robust, its earnings will increase and its stock price will rise. By keeping things straightforward, Lynch was able to concentrate on the most crucial task at hand: locating excellent companies. A stock that increases in value tenfold or 1,000% is referred to as a 10-bagger by Lynch. When managing the Magellan Fund, he was searching for these stocks. The first rule of spotting a 10-bagger is to avoid selling the stock after a 40% or 100% gain. These days, a lot of fund managers try to reduce or sell their winning stock positions while increasing their losses. It was plucking the flowers and watering the weeds, in Peter Lynch's opinion. Number 4. Look beyond what is visible. A wise man named Peter Lynch once observed, "During the gold rush, most would-be miners lost money, but the people who sold them picks, shovels, tents, and blue jeans made a good profit. Today, you can invest in companies that make switches and other similar devices that keep the network moving, or hunt for non-internet businesses that indirectly profit from internet traffic. As an investor, it's crucial to look past what the naked eye can see. There are many visible and promising stock ideas, but other businesses are trying to support the growth of those stocks. For instance, if a certain company's stock trades well on the market, everyone may see it. However, you should look further to find the other businesses and venues that contributed to the success of the stock in the hardware, retail, and other sectors of the economy. The benefits of investing in them can be seen. Before making an investment, you should do your research. 5. Losses may come. You shouldn't ever expect to be successful as an investor. Losses are unavoidable in your life. According to Peter Lynch, if you're good in this industry, you'll be right 6 out of 10 times. You'll never get things right 90% of the time. Losses do not necessarily indicate poor investing. If you invest in managed stock mutual funds, individual equities, or even index funds, it is inevitable that something will go wrong. What is an index fund? Index funds are mutual fund programs that place their corpus in shares that are a component of a specific index. In other words, these plans replicate an index's performance. These plans are made to follow the performance of a specific market index. These programs can be bought as exchange-traded funds or mutual funds, ETFs. The corpus of these plans, often referred to as index tracker funds, is invested in precisely the same ratio as it is in the index. As a result, if people buy index fund units, they essentially own a share of the portfolio that contains instruments for a specific index. The performance of the underlying index affects the performance of the index fund. As a result, when the index rises, the index fund's value rises as well, and vice versa. The Sensex and Nifty are India's two main indexes that are utilized to create index ETFs. Nifty is the index of the National Stock Exchange, whereas Sensex is that of the Bombay Stock Exchange. The term index fund refers to a mutual fund that resembles an index portfolio in appearance. The diversification of one's portfolio is becoming a very common choice among investors. People are aware of the advantages of diversifying their investment portfolios across several industries. Although there are many options for both rookie and expert investors, index funds frequently get the most attention because they are the funds linked to Nifty and Sensex. The fact that index funds should not be mistaken with actively managed funds is one of the factors contributing to their relatively cheap cost. The fund's sole objective is to keep the market as uniform as possible. They are not intended to perform better than other funds on the market, since portfolio diversity is the primary justification for investing in index funds. These funds assist investors in effectively managing their risk. Peter Lynch's record and stock-picking prowess speak for themselves. Despite the risk he incurred of over-diversifying his fund, he owned thousands of stock at some point. He mastered the art of observing his surroundings and comprehending both the present state of affairs and potential future developments. We can learn more about investing while interacting with our reality but putting his lessons and our own observations into practice. This makes investment more pleasurable and successful. What ideas or lessons about investing did you get from Peter Lynch? Please let me know by leaving a comment below. And if you enjoyed this video, please press the like button, turn on the notification bell, and subscribe to Wealth-ology for more videos like this. Thank you for stopping by to watch. See you in our next video.